and the third one is like premium allocation approach. First, I will like let you know that premium allocation approach is mainly applicable for the general short-term products, which is applicable for 1 year. So I will not discuss premium allocation approach in my presentation, and that will be covered by Mr. Onerous, because this is mainly applicable for the short-term policies. The general model is the core model, which has those again component, contractual surrender margin, risk adjustment, and the best estimate cash flow. So this is the core model that will be applied. There are some modification to the general model, which will be, when we apply those modifications, it will be used as a term variable fee approach. So basically, like general model is the key, which is like we apply for whole life, limited year term, without profit endowment. But when we say that for unit link or maybe with profit, so these type of product will be measured under variable. So at the moment, like maybe like you can estimate like these are the 3 core models under IFRS 17 standard. So we will be mainly discussing general model and variable fee approach. Just to give the broad overview, when we say that there is a core model, is general model, we apply some modification and it becomes variable fee approach. Variable fee approach will be applied like for unit link and with profit policies. So these are only difference between these 2 models. And by the way, when we will also look on how exactly these models will work through some examples. So in terms of difference, there is no difference in terms of cash flow estimation of future cash flow estimation. There is no initial recognition and subsequently. There is no difference. Risk adjustment will be measured exactly the same way. However, when we say unearned profit or the contractual service margin, as I mentioned earlier, the CSM, which is like your unearned remaining profit, which initially be recognized as liability. So that liability, initially there is no difference again, but when we say subsequent measurement, like initial and subsequent measurement mean like at time 0, you have an initial measurement because it was the issuance of the policy, and going forward, when we say that the liability will be measured, it has a different adjustment between the general model and variable fee approach.
We'll now discuss the changes in reporting of financial performance. We'll do that by, in contrast to the existing practice. So what I have here is a very simple illustration of the current practice under IFRS 4. We start by taking the premium income, which is actually the written premiums, and add to that the investment income to arrive at the total income. We take out the claims and expenses, and finally we adjust it for the movement in policyholder liabilities. That gives us the profit and loss. Going forward, the first change that's going to happen is that this performance will have to be split into 2 components. First of which would be the insurance service result. This would simply reflect the gains and losses on providing insurance service, and changes in non-financial variables, which could include things like mortality, persistency, expenses. Whereas the second component would be insurance finance income and expenses, which would reflect the investment income and the impact of discount rate and the changes in discount rates. The next change, which is a substantial change, is that the premium income, which is the written premiums, will be replaced by insurance service revenue, the insurance service revenue would vary with the model that is being applied. In the case of general model and the variable fee approach, the revenues, the written premiums will be replaced by a release in CSM plus the expected claims and expenses. Whereas under the premium approach, the simplified approach, this would be the earned premiums directly. Now, it might seem a bit vague at this stage, but it would become clear as we will work through the examples. Other changes that include are the claims incurred, the claim reserves. They'll have to be valued on best estimate, and there'll have to be an explicit margin for risk. Currently, the practice is to value claim reserves on a prudent basis and to build in the risk margins within the reserves. But this will now have to be segregated. And finally, and most importantly, we will no longer need the movement in policyholder liabilities to compute the profit and loss. So let us start with the first example. We'll take a very simple case of a single premium term life plan. We assume 1 million sum assured, a 3 years term, and a 10% discount rate. Now, In each of the examples that we discuss, we have made some simplifying assumptions so that we can focus only on the key components. So for this one, we have assumed that we have ignored actually the risk adjustments and the expenses. Also, for all examples in this session involve extensive calculations, and it was not possible to discuss each and every bit of the calculation, but we have tried to focus here on the key elements only. Now, a term life plan has to be measured under the general model. What I have here is a calculation of the contractual service margin at the initial recognition, that is at time 0. And besides that, I have the calculation in the subsequent years for the next 3 years of the policy. CSM at initial recognition is determined using the fulfillment cash flows. What fulfillment cash flows actually represent is the amount that an insurer needs to have to fulfill its obligation towards the policy holders. So what the company needs to do, it needs to calculate the inflows that it expects, which in this case would be a single premium of 8,000 only, and subtract from that the claims that it expects to pay over the term of the policy. So in this case, this gives us a profit at initial recognition. Now, this profit under IFRS 17 cannot be recognized immediately. Instead, this has to be recognized gradually over the term of the policy, and this becomes actually the starting CSM at initial recognition. Now, upon subsequent measurement, when we move to the end of the first policy year, what we do is we take the opening CSM and we add to that the interest accretion. Now, to put it in simple words, interest accretion is just the expected investment income on the opening balance of CSM. This would give us the balance as at the end of a particular period. Now we need to decide how much of this balance has to be recognized in the P&L. What the standard requires is that this balance be recognized in some form, in some relation to the amount of service that has been provided in that particular year or period. Now this can be done in many ways. For this example, what we have assumed that the services are provided evenly for each of the 3 years. So what we did for the first year was we took the opening balance, add to that the interest accretion, and took 1/3 of that into the P&L and held 2/3 for future years. We then repeated the entire process for second and the third year. Note that here at the end of the third year, which is the end of the policy, there is no residual CSM. That is because the entire profit expected from the policy has been gradually transferred to the P&L. Here I have a simple illustration of what is being done today as IFRS 4 in the top table, and at the bottom I have what might look like under IFRS 17. So today what we do is we start by the written premiums in the year in which we receive them. We add to that the investment income to arrive at the total income, and then we subtract the claims and adjust for change in future liabilities to arrive at the profit and loss. Now what we will do in the new standards would be entirely different then. There we will start with the release in CSM, which we discussed in the previous session, the slide. And we will add to that the expected claims. Now, it might be a bit surprising to see expected claims being treated as revenues, but we'll discuss the rationale behind that in the next slide. This CSM and the expected claims would give us the insurance service revenue. From that, we would subtract the insurance service expense, which in this example would be the claims incurred. The net of these two would give us the insurance service result, that is the first component of the financial performance. For the second component, the finance income would, in this simple example, simply be the actual investment earned during the period. And from that, we take out the insurance finance expense, which again, which reflects the time value of money on the policyholder liabilities. Again, in simple words, it is the expected investment income on the opening insurance contract liabilities. The net of these two gives us the net financial result, and the total of insurance service result and the net financial result is actually the total profit and loss for the period. Now, we have taken two very different approaches to calculating profits, but what's important to note is that in aggregate across the 3 years, the total profits from the plan remain the same. Be it IFRS 4 or 17, we have the same profits, it's just that we are recognizing them in a different pattern. Under the current practice, what we do is we take a huge portion of that profit upfront, whereas going forward, the new standard requires that we take it much more evenly. Coming back to the expected claims being treated as revenues, for that we'll have to understand the sources of profit from an insurance contract. Broadly speaking, there are two sources of profits in an insurance contract. First is the amount that was built in the product design, and second is the gain or loss that arrives from the deviation of actual versus expected variables. Now, what IFRS 17 does is that it explicitly identifies both these components. So the release in CSM is actually a component of the profit that was built in the product design, whereas the gains from movement in actual and expected are identified by including expected claims and expenses in the revenues and including the actual claims and expenses in the expenses.
This is the like liability measurement in terms of IFRS 4 and IFRS 17. When we say that, like, if you may have noticed, like, there is a contractual service margin in the IFRS 17, that this liability, which is like unearned profit, that will be recognized over the term of the policy. Even in this example, we have assumed very simple terms like there is no risk adjustment. However, like, if there is a risk adjustment, it also becomes part of the fulfillment cash flow, and the change in the risk adjustment will also go into the, like, revenue account. So in this scenario, like, we can see that again, if we compare, like, claim reserve as well as, like, present value future cash flow as per IFRS 4 and IFRS 17. So the expected present value expected future cash flow as per IFRS 17 initially is there, and then when we say that this negative amount basically is exactly the residual amount from, like, inflows and outflows. So that residual amount is actually your contractual service margin, which will be recognized over the term of the policy. In this example, we just we try to explain the concept of onerous. Onerous means that it's a loss-making policy. What will happen? Basically, when we say that the residual amount is the CSM, which is like unearned profit, but in the case of a policy which is designed, or maybe like single policy which may become like at time zero, at initial inception, the policy is not profitable. It's a loss-making policy, and it happened in the terms of life insurance. So in that scenario, in the same example, we just assume that 8,000 premium will become like 4,000 premium, and all the, like, cash flows, expenses, everything is same. So obviously you can see that as per IFRS 4, there's a 4,000 premium received, investment income is there, and the claim incurred, and then the change in future liability will remain the same, but at time zero there's a loss of 1402 amount. So that is a loss we recognize as per IFRS 4. But when we see that in terms of IFRS 17, there was it is not allowed to recognize any profit at time zero, at time inception. But if there is any loss, which means that it's an onerous policy, you need to recognize loss immediately. So profits will be recognized over the term of the policy, but if there is any loss, it will be recognized immediately. So, and the loss is exactly the same, that at initial measurement, the excess of present value outflows over present value of inflows at time inception. So that the losses will be recognized in the revenue account, and going forward, there unless, like, if there any subsequent measurement, which is a slightly complicated example. So in case of subsequent adjustment, like, if you update your assumption, your premium may change, your assumptions may change, so that loss may categorize into different groups of category. So that will be the grouping we will cover in the next slide. But in terms of, like, presentation, just to give you the idea, like, what is the owner's contract. If the policy is loss making, the loss has to be recognized upfront.
Now let's move on to the second example. We'll now take a unit link product. Again, to keep it simple, we'll take a single premium unit link product. We assume a single premium of 15,000 and a benefit term of 3 years. Upon death, higher of 17,000 or the account value would be paid. Upon maturity, the total account value is payable to the policy holder. There are only two charges in this product. There's a 5% upfront charge of the single premium, and there's a 2% of account value deducted at the end of each year. Now, again, in this example, we have also ignored the risk adjustment and expenses. And in this one, we have also assumed that the discount rates and investment incomes are equal, so that we can keep the things simple. Now a unit link product is measured under the variable fee approach, but the calculation of CSM at the initial recognition remains the same. We start by taking the fulfillment cash flows, which would include an inflow of 15,000 single premium, and the outflows would include both the expected death payments and the expected value of maturity payments. These cash flows would include the account values, but they'll have to be designed such that the net result is only what belongs to the insurer. So in this case, the net balance has to equal the present value of charges less any claims that the company has to fund from its own resources. This profit again will have to be recognized over the term of the policy, and that is why it becomes the starting CSM. Now upon subsequent measurement, this is where the variable fee approach differs from the general model. In the variable fee approach, we don't take the interest accretion. Instead, what we do is we add to the opening balance the actual investment income earned, that is the total. We subtract from that the finance expense. Now, finance expense reflects the amount of investment income that belongs to the policyholder. This net balance gives us the opening unearned profits plus something that was earned during the period, and this balance now has to be recognized over the term in some measure of service. For this one, we have assumed that the profits would be earned in relation to the number of surviving policies. So what we do is we take the opening balance, we add to that the total investment income, and we subtract what belongs to the policyholders and adjust and take some portion of into the P&L and keep the rest for future years. We do that for second and third year, and again at the end of the policy there's no unearned profit, all of it has been transferred to the P&L. Again at the top I have IFRS 4, and at the bottom I have IFRS 17. We start by, in the current practices, we start by taking the single premium, which includes the deposit component. Amounts that will directly go into the account value are also reflected in the revenues. We add to that the total investment income, and again subtract the claims and adjust for changes in liabilities to arrive at the profit. But going forward, what will be done is that we'll take the release in CSM, which we discussed in the previous slide. We add to that the expected claims. Now there's an important distinction here. In the current practices, the claims include the deposit component, whereas going forward only the amounts that have to be funded by the company will have to be reflected in the profit and loss accounts. So any debt payment in excess of the account values will be reflected in the P&L. If the entire account value is being paid only, then there will be no claim from this perspective. Likewise, if you can see, there's no claim payment in the third and the IFRS 17 statement. That does not mean that no death benefits or maturity benefits were paid. It simply means that whatever was paid out actually did not belong to the company and was not funded from the company's resources. This gives us the insurance service result, and then we add to that the net financial result. In this example, it's 0 because we have assumed that the discount rate and investment income are equal. Again, in this example, it's important to note that the total profits have been same across the 3 years, but the pattern has changed substantially. Because of the first upfront 5% charge, under the current practices, a huge portion is recognized immediately, and smaller amounts are recognized in the future years. Whereas in the new standards, this would be much more even across the years. The insurance contract liabilities for unit-linked products under the current practices comprise mostly of the unit reserves, which is simply the value of assets underlying those liability policies. Now, there are some other small reserves which we have ignored in this example. And the total liabilities in the current practice are basically the total of unit liabilities and the claim reserves. However, in the new standards, we won't take the value of underlying assets directly. Instead, we will take the fulfillment cash flows, add to that the CSM, that is the unearned profit, to arrive at the liability for future years, and then finally we add the claim reserves to arrive at the total insurance contract liabilities. Now, given the nature of a unit-linked product, it's important to discuss what will happen if the actual investment income turns out to be different than the expected investment income. So let us take a case where the actual investment income turns out to be 12%. Turns out to be 12% instead of 10%. Now, because it's a unit-linked policy, a large part of this increase would be transferred to the policyholders. But the increase in the charges that a company deducts